One of the biggest mistakes new traders make is over trading. More entries, more risk, more trades. They think it means more profit. But profit doesn't come from trade volume. It comes from risk management and the risk to reward ratio of the trades you have placed. In the next few minutes, I'm going to show you why more trades doesn't mean more profit, why professional traders actually take fewer trades, and why RRR is where your profit is made. I'm Jack Beanie, a trader with over 8 trading years experience inside the markets and multiple funded and personal trading accounts. If you're tired of having multiple losses in a row, incorrect risk management, and always feeling like you're behind while everyone else is winning, you are in the correct place. Problem: over trading. Most traders think more trades equals to more opportunities. But what actually happens? It means you place more bad setups, you place incorrect risk to reward ratio, and you end up being emotional towards your trading. Professional traders like me let trades come to us instead of trying to find or make trades inside the markets. So some days, no trade is the best trade you can take. Here's why trade volume doesn't work, and it's not in the number of trades. It's all about the expectancy of that trade and the outcome you're after. So I'm now going to give you 2 examples. One is going to be an example of 30 trades placed, and the other one is going to be of 5 trades placed. So number 1, I'm a trader, I've placed 30 trades. I've just put a 1 lot on every trade I've placed. So I've not calculated the risk and I've not calculated the correct lot sizes for a 1% risk. I've just put 1 lot on every trade I've placed. We're going to have a 40% strike rate. So out of 30 trades means I'm only going to win 12 and I'm going to lose 18 trades. But because I only put 1 lot sizes on everything, on the 18 trades I've lost, some of them will be a 0.5% loss and some of them could be up to a 4% loss. So meaning where we haven't got risk to reward ratio to back us and actually make us money even though we're losing trades, we are going to be seriously in the negative, because a lot of the trades that hit stop loss are going to be at 2 or 3%. So basically what I'm saying is, if you don't calculate the lot sizes correctly, your risk to reward ratio and the risk on each currency pair and each trade, because every trade has a different stop loss, you're going to then be in the losses. Compared to if we got a trader like me, who's neat, understands, sticks to his check sheet, we place 5 trades. We lose 3, but we've only put 1% risk on all of them trades, so we've lost 3%. The other 2 trades come in at TP, and we've risked them out as a risk to reward ratio to be a 1 to 4. Meaning we made 8% on the 2 trades that hit TP, and we lost 3% on the 3 trades that hit stop loss. So that still gives us a profit of 5%. So we've really brought down the amount of trades we are placing, but actually we are now a profitable trader just because we're putting systems in place before we take the trade. So what I'm saying is, trader 2 will always come out on top because they are using risk to reward ratio, risk itself, and calculating lot sizes correctly before placing trades, compared to someone who is lazy and are just sticking the same lots on all trades they place and not doing any of the back end work.
Check. I'm sure people are asking, but how do you find all these systems and equations to use? Description below, Limitless Trading Club. It's free now.
Free.
Join it.
As Sam said, link below, and it's free. So now that you have joined the Limitless Trading Club, found the resources section and found the lot size calculator so you can place the correct lot sizes for the trades you're placing, we're now going to go over risk management and RRR in more depth. This is because that's what actually pays you, and not entries and not indicators. So I'm going to say this once and once only. You should only risk 1% on all of your trading capital, and I personally risk 0.5% on all funded accounts that we have passed. And this just makes it easy for you in trading. You're not emotional towards trading. You don't lose any funded accounts you've got, because as a trader, we can always have 4 or 5 bad losing trades in a row, and it allows you to get risk to reward ratio correct when you only risk 1%. Professional traders think in R multiples. And what that means is we are looking for a ratio back from the amount of money we're sticking into the markets. Let's look at our £100,000 personal account I trade. We've got £100,000 in there. We risk 1% per trade, is £1,000 on each trade we place. So if I enter a trade on Euro USD, and that's a short position or a sell for anyone who doesn't know what that is, and we're looking for a 1-to-1 risk to reward ratio, meaning if we put £1,000 in, we're only looking to get £1,000 back. That is not a very good deal, and it's classed as a negative risk to reward ratio. You would only really use this if you are using an AI system and you're looking to pass funded accounts. From that, any manual trades or anything you are trying to be profitable on needs to be a positive risk to reward ratio. So for instance, a 1-to-2, meaning we put £1,000 in and we look to get £2,000 back, that is a positive risk to reward ratio because we are gaining more back than we are actually investing. This is a normal, really good beginner risk to reward ratio, but it does mean you need a really high strike rate of over 50%. So for traders like me, who only have a 35 to 40% strike rate, we need a slightly bigger risk to reward ratio. So I place trades between a 1-to-4 to a 1-to-6 risk to reward ratio. Meaning, again, simple. If I'm putting £1,000 in and that trade hits TP, I'm looking to gain back £4,000, £5,000 or £6,000 from that trade I placed. And as I said previously, that's what allows me to be a trader that loses more trades than I win, but still be profitable. So think about that in the longer term. Think about profits over a yearly period, and also about the amount of trades you are placing, because you don't need to be placing loads and loads of trades. You just need a better risk to reward ratio. So stop placing 30 trades a month and start placing 5 with a 1-to-4 or 1-to-5 risk to reward ratio, and that will make you a more profitable trader. Again, if you're now inside the Limitless Trading Club, you can find all of this step by step in the classrooms, and also ask questions in the live Q&As we have weekly. But I just want to final up on that last bit, is that just because you've got a bigger risk to reward ratio doesn't always mean you're going to be more profitable. You need to find the sweet spot for your strategy. For me, I have a 1-to-4 or 1-to-5. We also have some AI strategies which are a 1-to-2, a 1-to-4, and also a 1-to-5.9. But that strategy probably places 1 trade a month, again 12 trades a year, and we're profitable probably 4 to 5 of them trades. So think about risk to reward ratio as well as risk management in your trading, and this will help you become a better, profitable trader with less emotions, and you will enjoy trading better. If you want to watch more trading content, head over to the Limitless Trading Club YouTube channel, where we upload a new video every Monday.